$58 billion vanished from the London Metal Exchange in 11 minutes. Not stolen, not hacked, simply erased from existence by exchange administrators who decided that massive profits from silver trading weren't legitimate. The largest rug pull in financial history just happened to everyone who bet against the banks. This isn't about market risk or trading losses. This is about the moment when the world's oldest metals exchange abandoned every principle of fair trading to protect the institutions that were losing the most money, and proved that markets exist only until the wrong people start making money. What I'm about to reveal will change how you think about every financial market, every trading platform, every investment you've ever made. Because if the London Metal Exchange can erase $58 billion in profits with the stroke of a pen, no market is safe from manipulation when powerful interests are threatened. The carnage began at exactly 4:23 a.m. London time, not with a market crash or system failure, with an administrative decision that destroyed the life savings of thousands of traders while saving the balance sheets of institutions that should have failed. 237,000 silver contracts, legally executed, properly margined, legitimately profitable, all canceled by exchange decree because the people making money weren't the people the exchange exists to protect. Let me show you exactly what happened. Who made the decision to steal $58 billion from traders? And why this proves that every major financial market is rigged against anyone who is unconnected to the banking cartel that controls global finance. The setup had been building for months, silver prices climbing steadily as industrial demand outpaced mining supply. Investment demand increasing as inflation concerns drove money toward precious metals. Short sellers confident that prices would retreat from elevated levels. Standard market dynamics, bulls betting on higher prices, bears betting on lower prices. Both sides risking their own capital based on their analysis of supply, demand, and market conditions. But the short sellers made a catastrophic miscalculation. They weren't just betting against silver prices, they were betting against a supply shortage that was about to become a supply crisis. Physical silver inventories were depleting faster than mining production could replenish them. Industrial consumers were competing with investment buyers for limited supplies. The mathematics of available silver versus outstanding contracts were approaching breakdown conditions. When the squeeze began, it accelerated beyond anyone's expectations. Silver prices that had been climbing gradually suddenly spiked vertically. Not over days or weeks, over hours. 15% gains in single trading sessions, 25% moves overnight. Short sellers who had sold silver they didn't own found themselves facing margin calls that exceeded their available capital. Not small margin calls. Liquidation-threatening demands for additional collateral that forced position closures at massive losses. The pain was concentrated among the largest players in silver markets. Major banks, hedge funds, institutional traders who had built massive short positions expecting silver prices to moderate. These weren't retail traders gambling with lunch money. These were systematic important financial institutions whose silver losses threatened their capital adequacy and operational survival. By 4:15 a.m. London time, margin calls had reached critical levels. 17 major financial institutions faced potential insolvency if forced to cover their silver short positions at current market prices. The London Metal Exchange had a choice: allow market forces to continue, potentially destroying some of the largest financial institutions in the world, or intervene to protect those institutions by canceling the trades that were causing their losses. They chose intervention. The decision was made in an emergency board meeting that lasted 11 minutes. No public announcement, no advance warning, no consultation with the traders whose profits were about to be stolen. At exactly 4:23 a.m., the LME declared extraordinary market conditions and invoked force majeure provisions to cancel all silver trades executed after midnight. Not suspend trading, not halt new positions. Cancel completed trades that had already generated profits for traders and losses for banks. $58 billion in legitimate profits simply erased from existence. The official justification was market integrity and systematic stability. Translation: the banks were losing too much money and needed the exchange to save them from their bad trades. But the mechanism they used reveals the stunning corruption at the heart of modern financial markets. Force majeure is supposed to protect markets from external events that make contract fulfillment impossible. Natural disasters, government seizures, wars that prevent physical delivery of commodities. The LME used force majeure to protect banks from market movements that made their positions unprofitable. They perverted emergency provisions designed for genuine crises to steal money from traders whose only crime was being right when the banks were wrong. The precedent is terrifying. If exchanges can cancel profitable trades whenever large institutions face losses, then no market position is safe from retroactive theft. You can execute trades properly, manage risk carefully, analyze markets correctly, and still lose everything. Because exchange administrators decide your profits threaten their preferred institutions. This isn't capitalism. This is financial feudalism where markets exist to serve the banking aristocracy. and everyone else exists to provide them with risk-free profits. The London Metal Exchange just formalized this arrangement by demonstrating their willingness to steal from traders to protect banks. But the immediate aftermath reveals how systematic the corruption has become. Within hours of the trade cancellations, major banks began announcing that their silver positions had been restructured and their exposure reduced, not through market transactions, through regulatory intervention that transferred their losses to the traders whose profits were stolen. Goldman Sachs, which had been facing margin calls exceeding $2 billion, announced that their silver book was normalized and no longer posed systematic risk. JP Morgan Chase, whose short positions had hemorrhaged money during the silver spike, reported that recent market volatility had been managed without significant impact to their capital position. Deutsche Bank, which had been rumored to be seeking emergency financing to cover silver losses, suddenly declared their commodities division well capitalized and operationally sound. None of these banks covered their short positions through normal market mechanisms. They were saved by exchange intervention that canceled the trades causing their losses, socialized losses, privatized profits, protected through exchange manipulation that makes Bernie Madoff look like an amateur. But the traders who lost $58 billion to LME theft have no recourse through normal channels. Legal challenges face an exchange that operates under regulatory frameworks designed to protect the exchange from trader lawsuits. The LME's terms of service include broad force majeure provisions that traders agreed to when opening accounts. Regulatory complaints must be filed with authorities that include the same officials who approved the trade cancellations. The Bank of England and Financial Conduct Authority aren't going to punish the LME for protecting the banking system they regulate. Political pressure requires politicians who aren't financially dependent on the same banking institutions that benefited from the trade cancellations. Most members of Parliament have closer relationships with bank lobbyists than with commodities traders. The system is designed to prevent accountability when exchanges steal from traders to protect banks. Every possible avenue of recourse is controlled by institutions that benefit from exchange manipulation. The traders who lost $58 billion are discovering that they were never participants in a fair market. They were sheep being led to slaughter by wolves who control both the market and the regulatory system that is supposed to protect market integrity. And this wasn't the first time. The LME used identical tactics during the 2022 nickel crisis. When nickel prices spiked due to supply disruptions from geopolitical conflicts, Chinese trading companies faced margin calls that threatened their survival. The LME response was immediate and decisive. Cancel the trades, settle positions at artificial prices, save the Chinese companies while destroying everyone who had bet correctly on nickel price increases. The same exchange, the same methods, the same theft disguised as market stability. The difference is scale. The nickel theft involved $12 billion. The silver theft involves $58 billion. The LME is systematically stealing large amounts of money from traders while perfecting the techniques that allow them to do it with minimal legal consequences. They're becoming more efficient at organized financial crime. But the silver theft reveals something even more disturbing about the current state of global financial markets. The London Metal Exchange isn't unique. Every major exchange has similar force majeure provisions that can be invoked to cancel profitable trades when the wrong people are making money. The New York Mercantile Exchange, the Chicago Mercantile Exchange, the Shanghai Futures Exchange, all have regulatory frameworks that prioritize systematic stability over trader rights when major institutions face unacceptable losses. What happened in London can happen anywhere. What happened to silver traders can happen to anyone betting against institutions that have enough political power to rewrite market rules retroactively. Currency markets, stock exchanges, bond trading platforms, cryptocurrency exchanges, all operate under similar regulatory structures that allow for trade cancellations when systematic stability is threatened. The LME just demonstrated that no market is safe from manipulation when powerful interests are losing money. And the response from other financial authorities has been supportive rather than condemnatory. The Bank for International Settlements issued a statement praising the LME's decisive action to maintain market integrity during extraordinary conditions. The Federal Reserve's Vice Chair for Financial Supervision described the trade cancellations as appropriate regulatory response to systematic risks that threaten financial stability. The European Central Bank's Executive Board commended the LME for prioritizing market function over individual trader interests when broader economic stability was at risk. Global financial authorities are endorsing theft as appropriate policy when banks face losses that threaten their survival. They're establishing precedent that exchanges should protect institutions rather than enforce fair trading when the two objectives conflict. Every major financial regulator just announced that markets exist to serve banks, not to provide fair price discovery through competition between market participants. The silver theft at the LME received official approval from the global banking establishment, which means it will happen again and again and again. Every time major institutions face losses that threaten their survival, exchanges will cancel trades to save them while stealing from traders who bet correctly against them. Market manipulation is becoming routine policy rather than criminal activity. But the broader implications extend beyond commodities trading to every aspect of modern finance. If exchanges can cancel silver trades to protect bank losses, what prevents them from canceling stock trades when hedge funds face margin calls? What stops them from canceling currency trades when central banks need artificial support for their interventions? The precedent establishes that no profitable position is safe from retroactive cancellation when it conflicts with institutional interests that control regulatory policy. Investment strategies, retirement accounts, trading platforms, cryptocurrency exchanges, all vulnerable to the same theft disguised as market stability. The London Metal Exchange just demonstrated that individual traders exist only to provide liquidity for institutional players. When institutions lose money, individual profits get stolen to compensate them. $58 billion vanished from the LME, not because of market forces or trading risk, because exchange administrators decided that bank losses were unacceptable and trader profits were expendable. The largest theft in financial history happened in broad daylight with full regulatory approval and media support. And nobody faced consequences except the people who lost everything to systematic fraud protected by government endorsement. The London Metal Exchange revealed the true nature of modern financial markets. They're casinos, where the house changes the rules retroactively whenever they lose too much money to players who bet correctly against them. Except in real casinos, the criminals get arrested when they steal money from gamblers. In financial markets, the criminals get congratulations from regulators when they steal money from traders. The silver theft at the LME wasn't market volatility. It was organized crime with government permission. And it is going to keep happening until people understand that participating in rigged markets makes them victims of a system designed to transfer their wealth to institutions that control the exchanges, regulators, and politicians who make the rules. $58 billion stolen in 11 minutes proves that markets aren't free. They're controlled by criminals who change the rules whenever honest people start winning. The London Metal Exchange just admitted it. The question is whether anyone will listen.